Hi everyone, this is Fan Liang from MoneyWise Smart. Do you know that over the past 5 years, the pet stocks have actually performed very well due to the booming pet economy? The S&P 500 had gone up by 100%, but some pet stocks like Trupanion and Idexx Labs had gone up by 500 something percent. Zoetis had gone up by 264%, and Freshpet had gone up by 1,800%. Aren't these amazing returns? Which is why today we are going to talk about one such pet stock called Trupanion, which provides medical insurance for pets. In particular, we'll talk about how Trupanion was started, its business model, the market size and the financials, the moats, the growth drivers, and the valuation of the company. Before we start, I would really appreciate if you can help to hit the like and subscribe buttons so that more people will get to know more about this company. It takes a long time to research the company and prepare the video, so your support will go a long way in motivating us to produce more videos on good companies to own. Let's start with the story of how Trupanion was founded by this gentleman, Daryl Rawlings, who is still the CEO today. In 1983, when Daryl was a teenager, his 2-year-old dog, Mitzi, had a twisted stomach and needed surgery to save her life, which would have cost $3,000. However, Daryl's parents simply could not afford it, and he and his family had to leave the veterinary clinic without their dog. That experience stayed with Daryl, and he knew that there had to be a better way of handling the problem faced by so many pet owners on how to fund unexpected veterinary invoices when pets become sick or injured. The idea stuck with him for 15 years. And in 1998, after he sold a cigar business that he had started, he used the proceeds to bootstrap Trupanion. His goal is for Trupanion to solve the problem that it is very difficult for pet owners to budget for veterinary expenses because owners just don't know whether their pets are lucky pets or unlucky pets, when their pets will get sick or injured, or how much the medical bills are. So Trupanion helps to eliminate all these uncertainties. You might be thinking now, what's so special about pet insurance? Let's look at how fast the pet insurance market and Trupanion have grown. From 2015 to 2020, the pet insurance market in America had grown by 23% a year, from less than $1 billion to $2.2 billion in 2020. In 2020, Trupanion had a revenue of about $500 million, so it had one of the largest market share at around 23%. And it grew faster than the industry too in 2020, at 31% compared to the industry's 26%, thereby taking market share. The good thing about the pet insurance market in the North America is that it has a long runway. The US and Canada markets are massively under-penetrated at just about 1 to 2% penetration, which is very low compared to the other developed countries. For example, the UK with a 25% penetration, and the Scandinavian countries with about 14 to 40% penetration. If the penetration in North America can increase to 25% level in UK, then the total addressable market in North America will be around 33 billion, which is 60 times Trupanion's revenue of $500 million in 2020. And Trupanion has grown very well over the past decade, at a compounded annual growth rate of 39% from 2010 to 2020. If you think about it, pet insurance is actually like a recurring subscription product for a software as a service or SaaS company. If you have an insurance for your pet, you're likely to keep paying the monthly premium until your pet dies, which makes it easy for Trupanion to maintain and grow its revenues year after year. Trupanion has a monthly retention rate of 98.7%. That means on average, it is able to collect around 78 months or around 6.5 years of premium before the customer stops paying. And Trupanion is not just chasing after growth blindly without caring about the profitability. It has been reinvesting its cash flows on marketing and advertising to attract new customers at a very high internal rate of return of 33 to 46% in 2016 to 2020 for its subscription business. And it has been mainly funding these reinvestments using its own free cash flows too, which have turned positive since 2016. So what's Trupanion's competitive advantages almost that allow it to earn high returns on investments? First, it has slowly built up deep veterinary relationships over the past decades. In 2020, it had 152 territory partners who are like direct sales partners for Trupanion, who help to visit 17,000 clinics every 2 to 3 months to educate on and promote Trupanion's products. This has helped Trupanion to have strong direct relationships with almost half of the clinics in North America, and with half of the active clinics with Trupanion using Trupanion's software and having a dedicated account manager with Trupanion. This strong relationship would take competitors years and lots of money to develop. Second, it has a strong value proposition for its insurance products compared to its competitors. In particular, it has the broadest coverage in the market, covering many items that the competitors don't cover, including hereditary and congenital conditions, and has no payout limits. However, it is still able to keep its prices rather competitive due to its strategy and efforts to be the lowest cost operator. This is where understanding Trupanion's cost plus pricing model helps. Based on its data and understanding of the market trends, Trupanion can estimate how much the average veterinary invoice for different categories and breeds of pets cost, and then it simply adds a 30% margin on those costs. This cost plus approach allows Trupanion to pay 70 cents on the dollar to the average pet owner over the life of their pets. After the VAT cost and other operating costs, it targets an adjusted operating margin of about 15% in the long term. This has been the target since it listed itself in 2014. The 15% target operating margin can be achieved, for example, by spending 71% on VAT invoices, 9% on variable expenses, and 5% on fixed expenses. When I first started looking at Trupanion in 2018, its adjusted operating margin was only about 10.5%, far below the targeted 15%. But in 2020, it had already achieved 14%, close to the 15% target. And this was achieved on the basis that they had decided to return more value to customers in terms of lower price. Where they used to target veterinary invoice expense to be 70% of revenue, but now they are willing to do it at around 72%. This means that for every dollar of fees that Trupanion collects from their customers, a higher and higher percentage of that fee is being returned back to the customers in terms of the medical claims and expenses, so the customers are getting more value for the price paid. Trupanion is effectively following the business model used by Costco, which the founder Daryl admires, by returning incremental efficiencies and skill benefits back to the customers in the form of lower prices, instead of earning more profits for Trupanion itself. Because Daryl knows that in the long run, doing this will help build a strong moat for Trupanion, and the company will profit from higher volume and market share in this large untapped market. Third, Trupanion has a data-driven advantage. It knows that for different breeds of pets in different locations in the country, they have different average medical costs. Therefore, it has been collecting very detailed data for more than 20 years to the zip code level, so that its understanding of the anticipated veterinary costs across many subcategories is much greater and more accurate than the other insurance providers, with it having more than 1 million pricing categories now. Many of the other insurance providers are not even collecting data at the subcategories level, and it will take them many years to catch up now. With the granular data, Trupanion can price its policies more accurately, understand the lifetime value of each subcategory better, allowing it to spend a targeted amount of money to acquire new pets while optimizing the IRR, the internal rate of return. Fourth, Trupanion has its own patented, automated, and direct veterinary invoice payment system, which means that when the pet owners visit the hospitals, they do not even need to fork out much cash for the treatments. Most of the time, they just have to pay 10% of the bill, and the remaining 90% is automatically settled by Trupanion directly with the hospitals. This compares to the traditional method, where it's still being used by many competitors, where the pet owners have to first pay a big sum of cash first, and then go through the pain of the claiming process, which will take ages and ages to be approved and processed. And some of the pet owners don't even have those cash in the hospital, or their credit cards have been maxed out and have to see their pets die without being treated, just like what Daryl experienced about 30 years ago. In early 2021, about 6,000 hospitals, or 25% of the total hospital population, have installed this Trupanion Express system, which is a significant increase from the 100 hospitals 6 or 7 years earlier in 2014. Trupanion is targeting more than 90% penetration by 2025. And this automatic direct payment really adds a lot of value to the pet owners. And also the hospitals, as it saves them a lot of administrative work and troubles too. Going forward, Trupanion has many reinvestment opportunities and growth drivers that it can leverage to drive its future growth. Recently, it has come up with a 5-year strategic plan to deliver growth in intrinsic value of over 25% per year through initiatives like expanding its existing core Trupanion product, introducing new lower price insurance products, going into complementary product lines like subscription wellness diet products sold exclusively through the veterinarians, GPS tracking device and resale of its own technology, and expanding into other international markets directly or through partnerships. I won't get into the details of these initiatives now in this video, but if you'd like to be notified when we produce more videos on Trupanion in the future, do hit the subscribe button now so you won't miss them out. Now, coming to the valuation, let's look at Trupanion's share price first. Since its IPO in 2014, its share price has increased by around 7 times in a 7-year span. And this is after a 25% crash in share price from its peak of $127 in early 2021. Amazing, isn't it? On the valuation, the good thing is that the company has done a valuation of its own shares, which we can refer to reward its management and employees. Trupanion grants shares to them, and the amount of shares granted depends on how much the intrinsic value of the company had grown that year. For example, if the growth in intrinsic value is less than 11%, then no shares are granted. If the growth is 25%, then new shares are granted that will be equivalent to around 1.7% of the total outstanding shares to share the growth with the employees. This would dilute the net intrinsic value growth to existing shareholders to 23.3%. To estimate the intrinsic value, the company uses a 15-year DCF model. In 2019, using a discount rate of 10.8%, Trupanion estimates its intrinsic value to be $1.29 billion, or around $34 per share on a conservative, fully diluted basis. The company explains the whole DCF model in the shareholder letters to be transparent, so that if you want, you can read it and see if you agree with the assumptions. In 2020, Trupanion estimates that its intrinsic value per share has grown by 88%. This is partly driven by a decrease in discount rate use as the company becomes larger and has more dependable cash flows. Excluding the impact of the change in discount rate, the growth in intrinsic value is 29%. If we use the growth in intrinsic value of 88% in 2020 and the intrinsic value per share of $34 in 2019, we get an intrinsic value of $64 for 2020. This $64 intrinsic value is quite lower than the current share price of $90. However, do note that the $64 intrinsic value is on a fully diluted basis based on fully diluted share counts. But if the share options are exercised, Trupanion would actually get some cash proceeds, so this $64 intrinsic value could be understated a bit. In addition, Trupanion's DCF model uses purely historical data and extrapolate them, as the purpose is to reward the employees for what they have achieved, not what they think they will achieve in the future. So it has not included much future improvements in the calculations, and over the past few years, actual results have shown that their DCF is conservative. Furthermore, Daryl also notes that the company aspires to outperform the model if they can execute well and get blessed by Lady Luck. If you look at the share price, there were times this year when the share price was around $70, which is not too far from the $64 intrinsic value. Personally, I would continue to monitor the company and wait to see if the share price comes back down to the $60 range. But this is by no means any investment recommendations or advice. While waiting for the Trupanion's share price to come down, there are wonderful businesses that are available at much better valuations now. For example, Stone Cold, which Berkshire Hathaway has invested in, Wix, and Upwork, all of which are fast-growing companies with strong moats and tailwinds, which we have covered in detail in our channel. I'll provide the links to those videos in the video description below, so be sure to check them out. Overall, we have talked quite a bit about Trupanion today, on its business model, market size, financials, moats, growth drivers, and the valuation of the company. What do you think of the company? Let us know in the comments below, whether you like it or would you like to buy it. If you have enjoyed this video or have learned something, please help to smash the like button now if you haven't, and subscribe to our channel if you want to be notified of future videos on Trupanion or other great companies to own. Thank you very much, and we'll see you in our other videos.
Do join us in our investment forum on Facebook, using the link in the description below, where we discuss lots of interesting businesses and investing concepts. Do check out our multi-bagger research series at the link in the description below, where we discuss in detail great businesses to own and compound your wealth for the long term. These great businesses have high growth in revenue, profits, and free cash flows. For example, this global payments company has grown at a compounded annual growth rate or CAGR of 60 to 80%, while this technology company has grown its revenue at a CAGR of 80%. And this other payments company has grown its revenue and profits at a CAGR of 20+%. Check out our comprehensive option series course on option strategies to complement long-term investing at link in the description below.